Assalamualaikum and a very good day to Madam Zahira. I'm Muhammad Iqan Fazil bin Amir from Group 2, and today our group is going to present our business analysis of Petronas and Petron. So, firstly, I will briefly explain the background of Petronas and Petron Malaysia. Petronas is Malaysia's national oil and gas company and is fully owned by the government of Malaysia. It was established on 17 August 1974 to manage the country's oil and gas resources responsibly and sustainably. Petronas operates across the entire oil and gas industry, including exploration and production, gas processing and transportation, as well as refining, petrochemical, and fuel marketing. Petronas also has a strong global presence with operations in over 100 countries. In line with global energy transition efforts, the company is expanding into cleaner and renewable energy. It's play an important role in supporting Malaysia's economy through government revenue, industrial growth, workforce development, and environmental sustainability. Petron Malaysia, on the other hand, is a downstream oil company operating in Malaysia and is a subsidiary of Petron Corporation from the Philippines. It entered the Malaysian market in 2012 after acquiring ExxonMobil's downstream operations. Petron Malaysia owns the Port Dickson refinery in Negeri Sembilan, which has a capacity of about 88,000 barrels per day. The company produces fuel products such as gasoline, diesel, LPG, and aviation fuel, and operates a wide network of service stations across Malaysia to supply both retail and commercial customers. The following slide presents Petronas income statement, cash flow statement, and balance sheet. Subsequently, this slide presents Petron Malaysia's income statement, cash flow statement, and balance sheet.
Assalamualaikum, my name is Abizafan bin Shahizan and I will be continuing for part 2, which is business analytics applications. So here we can see the Petronas financial position, and then here we can see the Petron financial position. So here's a summary of the Petronas financial position. For cash flow, the trend is downward is due to the lower realized oil and product prices, divestments, and foreign exchange impacts, which reduce operating cash generation. And then we have the income statement, which the trend is slight increase due to the underlying profitability face pressure from lower oil price and tax divestment impacts, especially in 2024. For balance sheet, the trend is slightly upward. It's because due to its large asset base, retained earnings, and continued long-term investments despite the market volatility. For the summary of Petronas for Petron financial position, the cash flow has seen a trend of upward because the refinery operations recover post-pandemic, working capital management is improved, and operating cash inflows strengthened despite the margin volatility. And then next we have the income statement, where the trend is downward due to lower refining margins, volatile crude oil prices, and higher operating and financing costs, which compress profitability in the downstream oil sector during 2023 to 2024. And then for the balance sheet, we see a trend for slightly downward as a result of inventory value adjustment, asset depreciation, and balance sheet optimization amid weaker earnings rather than aggressive asset expansion. Next, we can see the Petronas linear regression here, and then we can see the Petron linear regression here. So for the summary of Petronas linear regression, we can see the revenue linear regression saw a downward trend because reduced sales value mainly due to lower realized oil and gas prices and weaker downstream margins despite the continued production. For the operating expense linear regression, it shows an upward trend, indicating that operating expense are increasing over time, implying higher operational maintenance and compliance costs, which further pressured net income. Next, we have net income linear regression, which saw a downward trend, which reflects the margin compression, higher costs, and weaker price environments, which reduce profitability faster than the revenue. Next, we can see the summary of Petron linear regression. The revenue linear regression saw an upward trend is due to the suggest improved sales Performance driven by stable fuel demand, recovery in oil prices, and stronger downstream activities. Next, we have the operating expense linear regression, which saw an upward trend. It's because this increase may be attributed to inflationary pressure, expansion activities, and rising compliance or energy-related expense. Next, we have the net income linear regression, which also saw an upward trend. The income has been improved over time, indicating that revenue growth has outweighed the increase in operating expense. This reflects better cost efficiency, improved margins, or stronger overall financial management, contributing to enhanced profitability. That is all. Thank you.
Hi, my name is Muhammad Takris, and today I will be presenting a financial ratio analysis comparing two companies, which are Petronas and Petron. The purpose of this analysis is to compare their financial performance by using several key financial ratios. This ratio helps us understand the company's profitability, liquidity, efficiency, and ability to manage debt. I will start with the net profit margin. Net profit margin shows how much profit a company earns after all expenses are deducted from revenue. From the result, Petronas records very high profit margins of more than 30%. This means that Petronas is very efficient in controlling costs and generating profit. On the other hand, Petron shows a very low and declining profit margins, which are close to zero in the most recent years. This indicates that Petron have difficulty turning its revenue into profit. Overall, Petronas is much more profitable than Petron. Next, return on equity or ROE measure how well a company uses shareholders' money to generate profit. Petronas maintains a stable ROE between 13 and 15%, showing that it uses its equity efficiently and provides a good return to shareholders. In contrast, Petron ROE drops to below 1%, which means that shareholders receive very low returns. This shows that Petronas perform better in creating value for its investor. Moving on to liquidity, the current ratio measures a company's ability to pay its short-term obligation using current asset. Petronas has an extremely high current ratio, which indicates a very strong liquidity position. This means that Petronas can easily meet its short-term debts. Petron's current ratio is lower but still above 1, showing that it can meet its obligation, although with less flexibility. Therefore, Petronas is financially stronger in short term. The quick ratio gives a more conservative view of liquidity because it excludes inventory. Petronas has a strong quick ratio, which means it can pay a short-term liabilities without selling inventory. Petron, however, has a much lower quick ratio, indicating that it relies more on inventory to meet short-term obligation. This suggests that Petronas has better immediate liquidity than Petron. Next is efficiency ratio. This ratio shows how well a company uses its asset to generate revenue. Petronas record higher ratio, which reflects better asset management and stronger operation. Petron show lower efficiency, meaning its assets are not used as effectively. This indicates that Petronas operates more efficient than Petron. Next, the debt to equity ratio measures how much debt a company uses compared to shareholder equity. Petronas has a lower and more stable debt to equity ratio, showing that it relies less on debt and faces lower financial risk. Petron relies more on debt financing, which increases its financial risk, especially when profits are low. Lastly, the interest coverage ratio measures a company's ability to pay interest expenses using operating profit. Petronas has a very high ratio, which means it can easily pay its interest expenses. Petron, however, is much lower, showing that it is more sensitive to changes in earning. This confirms that Petronas is more financially stable rather than Petron.
My name is Muhammad Ehsan. Under normal conditions, Petronas operates in a stable environment. Revenue stand at 5.18 billion ringgit, supported by stable oil prices and normal production levels. COGS of 3.51 billion moves proportionately with revenue, indicating consistent cost efficiency. Fixed cost of 924.8 million ringgit reflect routine operating, administrative and maintenance expenses with no aggressive expansion or contraction. Overall, this results in a stable margins and predictable profitability. In economic boom, revenue increases to 5.96 billion ringgit, or about 15% growth, driven by higher oil prices, stronger global demand, and increased product utilization. COGS rises by only 12% to 3.93 billion ringgit, growing slower than revenue and improving margins. Fixed costs increased moderately to 971.1 million ringgit due to expansion activities and higher workforce and operating costs. This operating leverage leads to significantly higher net income. In contrast, during an economic downturn, Revenue falls to 4.56 billion ringgit, down 12% due to lower prices and demand. While COGS declined to 3.23 billion ringgit, it does not fall as quickly as revenue. Fixed costs remain largely inflexible, resulting in margin compression and a sharp drop in profitability. For Petron, under normal conditions, revenue stand at 17.22 billion with COGS at 16.65 billion ringgit. Costs move closely with revenue, reflecting strong exposure to crude oil prices and refining costs. Fixed costs are stable at 135 million, indicating a steady operating structure but relatively thin margins. In an economic boom, revenue increases by 10%, driven by stronger fuel demand and higher selling prices. COGS rises more slowly at about 7%, showing positive operating leverage. Fixed costs increase marginally to 140.4 million ringgit due to higher activity and inflationary pressures. As a result, profitability improves significantly, highlighting efficient cost management during growth periods. In contrast, during an economic downturn, revenue falls by 10% to 15.49 billion ringgit due to weaker demand and price pressure. Although COGS declines, it does not fall proportionately, while fixed costs remain largely inflexible at 136.4 million. This combination severely compresses margins, leading to an operating and net loss of 57.5 million ringgit.
Assalamualaikum and very good day. My name is Ahmad Dina bin Azlan, and next I will talk about the 3-year projection model for our income statement for Petronas. So in 2035, we assume that Petronas is expected to experience a slight decline as the revenue falls by 3.6% due to the lower oil price, the weaker global demand, the currency fluctuation. Even though COGS decreased by 3% from efficiency improvement, the rising fixed costs and low capital expenditure result in lower EBIT and net income. Moving on to the 2036, where the year is still the control decline continues. Why? Because the both revenue and COGS is fall by around 3% due to the expansion and inflationary pressure. As a result, EBIT and net income contract further, reflecting ongoing market challenge. So finally, in 2037, we assume that the Petronas show signs of modest recovery. Why? Because the revenue growth can grow by 1% as oil price has stabilized. So overall, this projection highlight a Petronas' resilience and disciplined approach in navigating market volatility. Next, I will talk about the 3-year projection model for cash flow Petronas. So in this case, we projection that in 2035, Petronas faced an adjustment year whereby the net income drops 50% due to the weaker margins and lower oil price, but the depreciation at 4% helped maintain strong operating cash flow. Capital expenditure is reduced by 50%, showing a focus on liquidity preservation over growth. This is also according to Banama 2025 and Petronas 2025. So in the second one is 2026, where the cash flow strengthens, whereby the net income recover moderately by 5% as cost efficiency stabilize the margins. For in 2027, Petronas, we assume that the Petronas have achieved a balanced and sustainable financial position, whereby we assume that the net income is growing by 8%, which is the cash inflow peak, and the capital expenditure remains manageable at 5%. So overall, this projection highlight Petronas' disciplined approach to cash flow management and strategic investment. Lastly, I will share a brief overview of Petronas' NPV evaluation for its projected cash flow from 2035 to 2027, whereby the NPV calculation use a 10% weighted average cost of capital, which is WACC. The cost of capital is a conservative and realistic as we estimated it based on the oil and gas industry website, which is template 2024, where the range of 9.5 to 12.9%, so we choose 10%. Other than that is the resulting NPV, which is RM1116141 billion, which is the value is positive, so we indicate that the project is financially viable. So the expected cash flow exceed the cost of capital as a result. Other than that, to summarize it, the positive NPV confirm that the project potential to generate value and to support the Petronas planned investment decision. So that is all from us. Thank you.